What's up everyone, it's Karthik with MoneyVest. We got lots to discuss in this video as the NASDAQ hits a new all-time high and outperforming significantly the S&P 500, which was actually down on the day here, dropping a little bit over $20 billion, and a lot of the money still keeps on flooding into just a select few companies, and more specifically, it was really Tesla in Magnificent 7, up another 3% on the day. So NASDAQ rises to hit a new all-time high Friday as rest of the market really just lags behind. And, all-time highs, we got up to that level and then got rejected for the NASDAQ, still within the context of a rising wedge, which we'll go over later in the video. So this right here, the NASDAQ up over 0.5%, the S&P 500 was essentially flat, down about 3 basis points, and the Dow Jones here dropping a little bit more heavily as we did see significant rotation once again out of utilities, out of staples, out of some of the more defensive parts of the market over to a very risk-on rally as we trade near all-time highs. And so the Dow was down over 259 points on the day. So take a look at Tesla, yet another 13-month high, up over 3.3% to almost $270, a level that we haven't seen in such a long time here. Google also recovering a little bit over 1.5%. Meta up almost 1%. We had Microsoft pushing higher, Nvidia, Amazon, Apple, Netflix. So every single Magnificent 7 stock was green on the day. So all in all, over $158 billion worth of inflows for Magnificent 7. And some of the biggest gainers on the day, of course, we had Google, Tesla here up over $30 billion. We had Nvidia up $28 billion. Google was up $30 billion. We had Microsoft $25 billion, Amazon $15 billion, Meta $14 billion, Apple almost $13 billion. So all in all, these 7 companies combined brought in about $158 billion in inflows. So a lot of momentum still concentrated very much into Magnificent 7. So Tesla shares head for their highest close in 13 months as the post-earnings rally continues, and we know there's a lot of analysts on Wall Street that are not happy with this move higher, including JP Morgan. So she's saying that fade the Tesla pop earnings boost is going to be quote-unquote unsustainable. So I've actually done a couple videos on Tesla already. Why this time around, in my personal opinion, the probability for us to see a breakout has never been higher in the last 3 years, and it is more probable now for us to see a breakout than ever before because of a lot of the different growth waves that Tesla is in. There's a lot of different things that are coming together for the company. And again, the long term, of course, seems to be very strong. The momentum continues to be very strong. Now, from a purely fundamental standpoint, yes, the fair value could be argued at significantly lower levels. So obviously, Tesla's not a buy at 270 for me personally. But yes, from a longer term perspective, a breakout, this momentum higher, and with a lot of the pieces of the puzzle coming together, have never been more sort of bright in Tesla's future, right? So in those circumstances, I can tell you somebody may have missed out this rally here with JP Morgan coming in, calling this unsustainable. Sure, it is, from a technical standpoint, very overbought. So yes, this could be unsustainable, but at the same time, I think we have to understand what's driving the price higher. It is lowering margins that are now behind us. So the bottom is in for margins, profitability coming in with a very strong beat. Of course, the guidance also 20 to 30%, which may be a little bit more aggressive coming from Elon's mouth. However, like I said, FSDs and literally in the final verges of coming in together with unsupervised full self-driving as well. So all in all, portfolio was up over $5,000. It's done really well. So again, if you want to get access to all the trade alerts, options alerts, find out exactly what we're trading every single week. We've got so many people, so many members in our community that are just absolutely crushing it every single day with options and of course with long-term investing as well, with swing trading as well. So link's going to be down below if you want to join. Of course, be a part of our MoneyVest community. We've got a few more spots left if you're interested in joining us with that 16% annual discount that's also available until the end of this month. So you can pretty much save 2 months or get 2 months for free. And of course, get access to the MoneyVest website. Also, access to the MoneyVest Discord, options portfolio updates, trade alerts, engage with over thousands of traders, investors to learn from them as well. And this right here is the options portfolio. Huge differential this week. So portfolio crossing over 6% since we started, and S&P 500 with a decline because this past week the S&P was down almost 1% in the past week here. So nice little differential there. And that's exactly what the main focus is, to perform better than the S&P 500 with significantly lower amounts of risk. And this right here, of course, cumulative net profits now sitting at well over $6,000 since we started this portfolio about 7 to 8 weeks ago. So again, links gonna be down below. We'd love to have you on board. If you have any questions whatsoever, please do let me know. Now, in terms of the market rotation for different sectors, a lot of the outflows from utilities. So if you come over to stocks that were selling off the most, so in other words, that saw the biggest outflows, we had healthcare, T-Mobile, Berkshire Hathaway, JP Morgan, Johnson & Johnson, McDonald's, Bank of America. So financials, staples, more value-oriented stocks. You've got Philip Morris in there. If you come over, take a look at utilities more specifically, we had over a 1.4% decline for utilities, over $18 billion sell-off, and that's 31 stocks making up for just over 2% of the S&P 500. And again, we've got a lot of energy companies, utility companies in this particular part of the market. And then if you take a look at some of the other ones, for example, staples. So if I come over here and type in, let's see, defensive. No, that's aerospace and defense. Let's just do this right here. Health, leisure, and restaurants. So we got 0.5% decline, over $5 billion, which includes your McDonald's and your Domino's and Yum Brands and all that different types of food chains. Financial stocks, that's one sector that we can certainly look at over here. So if you type in financial services and even banks, we can include for banking as well. Overall, 1% sell-off, over $61 billion sell-off. This includes all your banks, including Morgan Stanley, JP Morgan, Bank of America, Goldman, Wells Fargo, so on and so forth. So pretty significant sell-off, and this actually has over an 11% weighting in the S&P 500. So where did all this money go to? Of course, big tech, Magnificent Seven. And I've been talking about this. This was one of the risks that I highlighted yesterday, that there is a lot of concentration, once again, in technology. So XLK, XLY, XLC. Those are your technology, discretionary, and consumer communication services. 3 sectors that were the only ones that were green on the day here. So a lot of momentum driving the markets higher, and the differential between utilities and technology continues to narrow in. And right now we're sitting at about 6%. So this right here, the differential is now come down to 6%. We've seen this number fluctuate in the last several weeks. We've seen this number go as high as 12 to 14%, come down to as low as 2 to 4%, and right now we're back down sitting at 6% for that differential between the performance of utilities and technology sector as well. Now, we did have Jeremy Siegel and Tom Lee on CNBC, so I figured I'd do a summary of what they actually talked about. It was quite interesting because Jeremy Siegel is now talking about pause from an interest rate standpoint from the Federal Reserve. So these are some of my notes. He sees the market momentum being very, very strong. This is a very strong market where he doesn't see any type of drop in momentum. GDP looks to be over 3%, which is going to be coming out next week. So by the way, if you come over to our market calendar, economic calendar, we've got a very, very important week scheduled because on a high impact basis, for next week, we've got GDP numbers, we've got the JOLTS numbers, we've got the PCE inflation numbers, as well as the unemployment numbers. So it's going to be a very, very jam-packed week here that's coming up, because not only the economic calendar, we've got a lot of high-impact items, but if you come over to the earnings calendar, yes, it's pretty packed here with most of the big tech companies reporting, such as Microsoft, and we got Apple, we got Visa, Waste Management, like I said, Altria Group. We've got Rocket Mortgages, McDonald's, Pfizer. All these companies are going to be coming out. We did have, of course, Google and Meta as well, which I think has been confirmed now to the following week. So I think this is when they are going to be reporting their numbers here. So I got to figure this out. Just give me 1 second, because I remember we did have Meta over here as well, which I don't think we do. There we go. So we do have Meta here as well, which seems to be pretty low here for the market cap that it has. So we'll push that up. But Meta's also reporting. And then let's take a look at Google. Google's most likely going to be the following week. Not next week, but the following week after. But let's see, where is it going to be? So we'll see when they report their earnings. But bottom line is, yes, we do have a lot of numbers coming out for the next week here. Supermicro, Amazon's down here. And then, of course, Meta's all the way going to be down here. Starbucks is also scheduled for next week as well. So economic calendar and earnings calendar, both of them are going to be very, very important. Long-term interest rates will continue their uptrend, is what Jeremy Siegel mentions. Fed is not going to lower rates as much as they promised, is what Jeremy Siegel says. And pause before the end of the year is possible. That's what he's talking about, that we're going to see most likely a pause before the end of the year if the labor market continues to be very, very strong. And a lot of FOMC members may decide on a pause. And Siegel still believes 25 basis points for one of the 2 meetings that we've got left for 2024. Now, when it comes to Tom Lee says the quality of the earnings season has been very, very good. It's been very high. More than 80% of the companies have beaten expectations on earnings so far, and this has been one of the strongest starts to the earnings season. He also says and admits that I've been fooled by seasonality because, seasonality-wise, October and September was supposed to not be such a great month. However, it's of course been very, very strong, and markets are increasingly betting on a Republican sweep, and they may take the Senate as well. That could also be one of the reasons why there is some removal of that uncertainty and the market continues to rip higher. Headline CPI could still be affected given the elevated prices on oil because of the tensions over in the Middle East, and transport costs have also spiked recently, and the markets may be skeptical that inflation could reaccelerate back up, but the Fed is still on track to bringing inflation down to a sustainable level and interest rates down to a neutral rate. And this is fully a buy the dip type of environment for the markets right now. Now, if you come over to where we are for the MoneyVest Index, we are at 3.62. So we are still in the optimistic zone. So for me, this is a level where, sure, you can make a case that, okay, S&P 500 more specifically, and if you're able to find individual stocks, there could be some buying opportunities out there. But given the strength of this market and the fact that we've been so narrow in this market, where it's really just been Magnificent Seven that's been pushing higher with a lot of inflows in market cap. First it was Nvidia, now it's Tesla. I think it's really important for us to remain cautious in this environment because we're still at 3.62. We're nowhere near close to those uncertainty or those fear levels, according to the MoneyVest Index, which is anything under 3. Somewhere between 3 and 3.5 is a neutral level for the market, and we're very close to being in neutral for this market as well. So keep a close eye with where we are in this MoneyVest Index. But right now for me, this is simply just enjoy the ride higher, sell calls, trade options, make money, and that's about it, right? So I'm not deploying capital just yet. If you see some volatility ahead of elections or the FOMC meetings in November, then yes, I'm going to be very much ready to deploy capital into the market. So again, you can see a lot of the liquidity flooding into more technology-oriented stocks here. And also, if you take a look at hedge funds, they are buying U.S. stocks at the fastest pace this year as well. So we're seeing a significant amount of inflows coming in from hedge funds as well. And that speaks a lot of volume because there's been a lot of money sitting on the sidelines for the longest time. There's been over $6.5 trillion in assets in money market funds. And so because of those reasons, I think hedge funds, institutional investors are now starting to finally realize what they've been missing out on. And they are aggressively deploying capital in order to take advantage of the rallies that we're seeing in the markets almost every day. Again, more concentrated and narrowed down on the Magnificent Seven stocks. But this is, again, a very, very significant, level that we're seeing hedge funds kind of buy U.S. stocks very, very aggressively on the year. Now, also very interesting catalyst was that New York Stock Exchange is considering to extend trading to 22 hours a day, opening at 1:30 in the morning and closing in at 11:30 p.m. That's going to be your extended hours. I believe that the normal regular hours are still going to be from 9:30 to 4 p.m. And then extension of that after hours is going to go from 4 p.m. to 11:30 p.m. And then pre-market's going to start at 1:30 all the way to 9:30. So that's an additional 8 hours of pre-market hours. And then that's an additional 7.5 hours of after hours. And so all in all, that's going to be totaling into 22 hours a day that you could possibly trade. Of course, different brokerages are going to have different accessibility to those pre-market and after hours trading. But it's really going to be 2 hours during the day. The markets are going to be strictly closed, and that's between 11:30 p.m. Eastern and 1:30 in the morning. So that's about it. I don't know how I feel about this. I think right now the structure is perfect, from 4 a.m. till 9:30 a.m. and then 9:30 to 4 and then 4 to 8 p.m. I think it's perfect. I don't know why anybody would want to trade 22 hours in a day. I think there's plenty of time to trade in regular trading hours. But under the new plan, trading on the NYSE electronic exchange would open at 1:30 in the morning and close at 11:30 p.m. on weekdays, subject to regulatory approval. And they plan to file updated rules for extended trading within the U.S. Securities Exchange Commission. So I don't know. I don't know who's coming up with these crazy ideas, but I'm not for this at all. Let me know in the comment section down below if you guys would be interested in trading 22 hours in a day. I know Robinhood allows for 24/7 trading, but that's for a very select few stocks, given the liquidity. And this could also be a way to manage liquidity. I understand, because if you've got more trading hours, you can kind of handle more orders. And because the markets are growing and because there's more demand from investors, there is more money flowing into the US markets. I totally sort of understand some of the more logistical reasons as to why this might be happening. Gives a little bit more of an edge to sort of hedge funds and, quant traders, because they're mostly trading on algorithms and artificial intelligence, as most people are going to be sleeping during those times. The AI and, of course, the algorithmic traders and quant traders are still going to be able to take advantage of these price action and these price movements during those trading hours, when pretty much nobody in the US at least is going to be trading. So there's pros and cons about it. Let me know your thoughts down in the comment section below. Now, coming over to the markets, and before we get there, I also want to talk a little bit about this relative rotation graph, which we have discussed previously. And you'll notice that XLK, which is your technology sector, has clearly moved into the improving quadrant. So there's definitely been a lot of improvement in technology, as we have addressed previously. And if you take a look at staples, right, XLP, it has moved into the weakening quadrant. It went from improving to leading to now weakening. And take a look at utilities and real estate. They are very, very close to a weakening quadrant entrance. We were, of course, leading for a very long time. This is going back 8 weeks. So you can see over here, we're going back to 8 weeks of relative rotation. And it's clearly seen real estate, utilities, staples, industrials, they've all come down from leading down to a weakening quadrant. And technology has clearly led this market higher from a lagging to a very improving part of the market. You've also got discretionary, which is kind of jumbled up here. Let me just see if I can lower down on those tails to see where we really are. So XLY is going to be this one right here. So you can see how it's actually moving from improving to now leading. Discretionary makes sense because Tesla's part of it, Amazon's part of it. And then we've got one more sector, which is communication services. Now, Google and Microsoft have really lagged. And again, Meta has also been kind of lagging a little bit more recently after hitting all-time highs. And that could be one of the reasons why it's also not really going anywhere. That's the red dot right in the middle. So what we really have here is real estate, utilities, financials, staples, going from leading to weakening. So there's definitely been a lot of weakness in those parts of the market. Technology certainly moving into in an improving quadrant. And we've got discretionary very much from improving to leading quadrant because of Tesla and Amazon. Technology more specifically because of semiconductors, which is NVIDIA, Broadcom, AMD, all those stocks. And communication services has really lagged behind. It's kind of like in the center, not really doing much because of Google and Microsoft and Meta. So that's where we are with the relative rotation graph. Now coming over to the markets, and NASDAQ here perfectly getting tagged at this all-time high of 18,600. So we pretty much touched that level. We are still very much in the context of this higher high and higher low. So got to be super careful because we've perfectly traded inside this rising wedge for a really long time. And you can see how perfectly this is played out. The only question is, are we going to see a drop, a breakdown from this rising wedge, or are we going to see a bigger breakout to new all-time highs? So that is still yet to be seen. Usually, not always. If you take a look at these rising wedge patterns, they break to the downside. Falling wedges break to the upside, but there is no hard and fast rule. Of course, with markets as chaotic as they can be, anything is really possible. So that's why we trade on probabilities and not on certainties. So resistance is going to stay put at 18,600 for the NASDAQ here. And again, the S&P 500 also trading sideways, seeing a little bit of a pullback. It was green at one point during the day, so there was a lot of intraday sell-offs. You can see that pretty much the entire day, the markets have done nothing but sell off. We kind of gapped out. We pushed higher a little bit, and from its highs of 58.62, we were down almost 1% intraday. So there's a lot of selling pressure here. Support level is going to stay put at 57.69. However, there's a lot of stocks that are doing really well, so Apple continues to move up and validating this higher low perfectly. So we had a very nice tag on this higher low. Resistance is going to stay put at 236. And that's going to be that higher low in support down to 221. Talking about Amazon, same thing. We're still struggling at this resistance of 189, 190. We've seen a very much lack of momentum here for Amazon. And resistance is going to stay put right about there, up to as much as this lower high, sitting roughly in the 189 to 191 for Amazon. Coming over to Tesla, and Tesla here giving us some hope, that we are going to see the highest close in over 13 months, level that we haven't seen since July 2024. We didn't really close at this level. If you go back, we haven't closed at this level in a very, very long time. We're talking, since September of 2020. 2023. So it's been well over 13 months since Tesla has closed at this level. So just under $270. And again, there's a lot of supply that is waiting right about here, a level that, like I said, we haven't broken out of in a very long time. So if we get to $300 this time around, it's going to be a huge game changer for Tesla. And the market cap, by the way, is sitting at $859 billion for the company as well. So very, very strong momentum for Tesla. Coming over to NVIDIA now. So NVIDIA also pretty much trading near all-time highs. Got a little bit of a breakout, I would suggest, but again, getting rejected at 144. So if you come over to the 30-minute time frame, you'll notice that we did see a little bit of a breakout over here. So very nice pop, but then getting rejected here at around 144 once again, and then rolling right back down. So support level is going to stay put down to 136. Huge resistance in the 144s for NVIDIA. Advanced Micro Devices also following a very similar trend to NVIDIA. Got a little bit of a push up, 1.8%. Higher low, and support level is going to stay put right about here. Resistance all the way up to as much as 173. I don't think this is going to be valid anymore because we already broke out above this, and we were validating that resistance here at 173, 174 for Advanced Micro Devices. Talking about PayPal, and PayPal here is still validating that support and slowly and steadily kind of making its way higher. And support level, like I said, is going to stay put at $81. Resistance all the way up to $88, $89 for PayPal. And a lot of consolidation sideways. And next target's pretty much at $89 for PayPal. Visa is also going to be reporting earnings next week. So Tuesday, October 29th, continues to pull back. We're seeing a little bit of a pullback from its resistance of 291. Support level right now is going to stay put at 278 for Visa moving forward as well. Talking about Meta platforms, and Meta also has been a little bit more on the weaker side in the last 4 to 8 weeks. Resistance is going to stay put at $602. We're still getting rejected here at $580. And support level down to as low as $541 per share for Meta as well. Google had a very nice day, pushing up over 1.5%. So it does seem like they're reporting next week on Tuesday, October 29th. So we should have them on the calendar here for next week. We had them last, there we go. Now it's updated. For some reason, it wasn't showing up earlier. But yeah, I was kind of curious as to why. Because they're sorted by market cap, so they should always be at the top. So that's what we have here. Google, Visa, Eli Lilly, Microsoft, MasterCard, Apple, Amazon, Meta, they're all reporting in the same week, which is next week. So Google, we've got on 10/29, Microsoft and Meta on 10/30. So just want to double check here. Meta is on 10/30 right there. We got come over to Microsoft on the same day. Yep, there you go, 10/30. Apple here is going to be on 10/31. Boom, right there. Amazon also same day as Apple, 10/31. Perfect. So we got all these earnings lined up for next week, which we have to be very, very, alert for. I'll be live to cover all of them. Now, Microsoft here, resistance staying put at 432. So this right here is going to be that level to watch here. And of course, we're seeing that support level roughly at $400. And then finally coming over to Netflix, and Netflix on the day, also pushing up pretty much 2 basis points, very, very flat. So not a lot for us to discuss, but support level is going to stay put at 737. And then finally coming over to Costco and Enphase. Costco consolidating sideways, down about 25 basis points, support 872, resistance 920. And then finally, Enphase here seeing a little bit of a recovery back up. Very nice move up, 3.3%, filling this gap slowly and steadily. And this right here is going to turn back into a support for Enphase Energy as well. So hope you all enjoyed this video and a complete update. Congratulations to everyone on this market rally. And again, if you want to join, be a part of our MoneyVest community, link's going to be down below. Access the MoneyVest platform with all the new features, members-only videos, options portfolio, trade alerts, Discord channel, Patreon access. Everything's going to be available with the link down below. As always, happy investing. I'll see you all in the next video.